بسم الله الرحمن الرحيم. رندرو.
What do you want to post? Like, yeah, you open tree file or make a duplicate. Make it extend also.
This one? Duplicate?
Make
السلام عليكم ورحمة الله وبركاته. هل الصوت واضح؟ السلام عليكم ورحمة الله وبركاته. هل الصوت واضح؟ بارك الله فيكم وعلى بركة الله إن شاء الله.
This one is not changing. Slide not changing. Can slide not changing? Can you close that? This is no. Yes.
No.
I will keep it.
This one is for tomorrow.
Doctor, you make it. This is not. This slide is for tomorrow. Today.
Sorry, I'm really sorry. It's my mistake. I'm sending the wrong email.
Oh, sorry.
He sent it wrong way.
So he has to, no, he has to, يفتش.
No, it's not common. Can you change? Try to change.
Yeah.
Okay. Okay. Because we have much around 15.
Okay, great. Well, good morning, everybody. My name is Andrew Naylor. Thanks for your patience. Great to see everybody. Yes.
بسم الله الرحمن الرحيم، الحمد لله رب العالمين والصلاة والسلام على رسول الله وعلى آله وصحبه أجمعين، أما بعد السلام عليكم ورحمة الله وبركاته. Our distinguished guests from the World Council, particularly the speaker, Brother Alfred, and Harry Martin. And of course, you acknowledge the presence of our director of the center, Dr. Yasser, and our distinguished guests who have come among the faculty members and students, and also from outside. That's the This session will be conducted, as we said earlier, in English. And this workshop is part of is in conjunction with our conference on gold investment, which inshallah will begin tomorrow.
Please, volume.
Volume. جزاك الله خير. محمد انت عارف ان شو the volume. جزاك الله خير. نعم. So is it clear now? Okay, thank you. You can say it. The Zoom. Yeah. Okay, thank you very much. Thank you. So we have two sessions, actually, online and offline. I think that's good. So I was telling that this training workshop, is in conjunction with the International Conference on Gold Investment, which will be held tomorrow and the day after, that is 15th and 16th. And inshallah, we invited shortly Dr. Yasser, the director of Sharp Center of Islamic Economics, to give an opening remark and welcome our guests. And after that, inshallah, I will introduce the speaker. I welcome our dean of the college, Prof. Munzir has just come. You're welcome, Prof. Munzir. Yeah. So I will be introducing, inshallah, the scholar, our presenter, and then after that, after his presentation, we will open up for the interaction of the floor. Okay. So may I take this opportunity to invite Dr. Yasser. He will be speaking in Arabic, and after his speech, I will give a brief translation of what he has said. You're welcome.
السلام عليكم ورحمة الله وبركاته. بسم الله الرحمن الرحيم، الحمد لله رب العالمين، والصلاة والسلام على نبينا محمد وعلى آله وصحبه أجمعين. بداية نرحب بجميع الإخوة والأخوات والضيوف الحضور، ونرحب بمجلس الذهب العالمي مستر أندرو مستر ماثيو ويلكم. في هذا اللقاء الذي نسأل الله سبحانه وتعالى أن يكون لقاء مباركا ونافعا. غدا بإذن الله سينطلق مؤتمر الدولي للجامعة القاسمية في الاقتصاد الإسلامي بعنوان الاستثمار في الذهب، الفرص والتحديات أو الممارسات، رؤية شرعية اقتصادية. والأخوة في مجلس الذهب دخلوا معنا كشركاء لرعاة هذا المؤتمر. ومجلس الذهب العالمي يعد منظمة دولية رائدة في قضية الاستثمار في الذهب، وحقيقة كانت لهم جهود طيبة فيما يتعلق بالصناعة المالية الإسلامية، خاصة في دورهم البارز في إصدار معيار الذهب من هيئة المحاسبة الإسلامية أيوف. كان بالتعاون، وهذا طبعا معيار 55 من معايير الأيوفي التي تنظم العمل المؤسسي الإسلامي. كان لهم دور بارز في إصدار هذا المعيار، وهم وإن كانوا منظمة عامة لا يعني يرتكز عملها على العمل الإسلامي، لكن أرادوا الدخول إلى يعني سوق المسلمين من الباب الصحيح كما يقال. فذهبوا إلى الأيوفي، وكان لهم دور بارز في تصور كثير من المسائل الشرعية. وكما يعني لا يخفى على شيء في علمكم، القاعدة الشرعية تقول: الحكم على الشيء فرع عن أصوله. فهم أهل السوق وهم أهل الميدان، وهم أفضل أناس يعني ينقلون لنا الصورة الحقيقية الفعلية لقضايا الاستثمار في الذهب. اليوم بإذن الله ستكون هناك ورشة تدريبية حول يعني أبرز الاتجاهات للاستثمار في الذهب، وستكون الورشة باللغة الإنجليزية. آمل بإذن الله أن تكون هذه الورشة نافعة ومفيدة. أكرر الترحيب بجميع الإخوة والأخوات، وأدعو الجميع بإذن الله غدا للحضور فعاليات المؤتمر الدولي، خاصة الأخوة من جامعة الجميرة، نرحب بهم ترحيب خاص، وغدا إن شاء الله سيحضرون معنا. كل الشكر والتقدير للإخوة المنظمين ولمجلس الذهب العالمي على قبوله بهذه الدعوة، وأسأل الله سبحانه وتعالى أن يبارك في جميع الجهود. السلام عليكم ورحمة الله وبركاته.
Thank you very much to Dr. Yasir, the Director of Sharia Center for Islamic Economics. He gives by welcoming the guests from the World Gold Council and the faculty members and the guests from Jumeirah University who is attending. And he has given a very interesting account of the role of Gold Council, particularly in the preparation of the standard of Gold 57 of the IOP, where the Gold Council was invited to give inputs towards the preparation of that standard. And he really appreciates the role of Gold Council in that. And interestingly, I had also the opportunity to translate that standard in English, and that's why I remember it. Okay. So, and he is also inviting everybody, inshallah, for the conference tomorrow. And he hopes that our session today will be fruitful and very interactive. And he wishes us all the best. Thank you, Dr. Yasir. Now, I think time has come for us to have our session, and I don't want to take a long time, but before the speaker begins to present his work, I would shortly introduce. And he sent me an SMS saying that he also has another side. Although he is one, but he is truly one. We have Matthew here, who will be helping in taking some of the questions from the floor. And I believe Andrew will be, they have a channel to pass the questions to Matthew. Thank you, Matthew, for coming. Now, Andrew Naylor joined the Gold Council in 2016. He heads the Council's regional office in Dubai and heads a public policy initiative globally. Prior to being appointed to his current role, he was the regional CEO of X in China. In China, based on Singapore. And I think that's where we had an interaction in Malaysia with Andrew. Before joining the World Gold Council, Andrew worked for international consultancy firm, Citadel Group, advising financial institutions on foreign investment and trade policy in Asia and regulatory reform. Andrew was chairman of the Singapore Bullion Market Association's Public Affairs Committee and is a member of the supervisory board of the EU ASEAN Business Council. He was a board member of the European Chamber of Commerce in Singapore between 2012 and 2019. Andrew regularly gives broadcast media commentary on global and political economic developments on BBC, Sky News channels, News Asia, and CNBC. I believe that's news to me also. I'll be going after Andrew to see all those treatments. Recent conference presentations include the Dubai Precious Metal Conference, Asia Pacific Precious Metal Conference, World Islamic Banking Conference, the Akash Mena, and of course, now this one, the gold investment. So Andrew, I don't know to talk a lot about his post-trade, etc. I'm just giving the time. So please you join me to welcome Andrew for the session.
Thank you, Mustafa, for the introduction, and good morning, everybody. Thank you to Dr. Yasser and Musa for hosting us today at this session. I'll do a bit of an introduction to the World Gold Council so you can understand.
We need to raise your voice.
I need to raise my voice. Sounds very loud.
Yeah, because actually until we are getting the microphone.
Okay.
So please.
Yeah, should I use it?
Yeah, please. This one. Because actually the sound is here. So
Okay.
for the Zoom. Okay. Good.
Right, we're just sorting out the mic for the people online, because I think it's quite loud here, but perhaps not on Zoom. So we'll just wait for that.
No, you can start.
I can start. A bit of a background to the World Gold Council first. You have an idea of what our role is in the organisation, in the global gold market, and we hopefully bring to develop. The World Gold Council is the international market development organisation for gold. We're based in London and have offices worldwide, in Dubai, Singapore, New York, Mumbai, Delhi, and Shanghai. And we work to improve the functioning and integrity of the global gold market. And the objective is to make gold relevant as a financial asset, as an investment asset, but also make the gold industry relevant as well. Because our members, who are the world's leading mining companies, they need a license to operate, a social license. And it's important that we don't just think about gold as an asset class, how it's used as a financial asset, but also how is gold being produced? Has it been produced responsibly? Has it been processed responsibly? Has it been traded responsibly as well, further up the supply chain before it becomes an investment asset? So a lot of our work is focused on that. And we do a number of things. Sorry, the slides are not moving, but okay, sorry about that. So we do a number of different things. We produce a lot of research and data on the gold market. We set standards as well. So we have set a standard for the large-scale mines so that they, or investors and end users, can be confident that the gold has been produced responsibly for a social, governance, and environmental perspective. Further down the supply chain, we also have a standard for retailers called the Retail Gold Investment Principle, and that's to improve and transform how gold is retailed to end users. So our consumers being treated fairly, is pricing transparent, is the gold that's being offered to them has been responsibly sourced. If it's a managed gold product, and I'll talk about that a bit later on, has the gold actually been identified, is it allocated, which is a key consideration within the Sharia standard that Mustafa was talking about. We also do a lot of work with end investors. We work with central banks, we work with pension funds, other large institutional investors to help them navigate the gold market. And finally, we deploy capital to improve how the gold market functions. So we were responsible for the introduction of the Shanghai Gold Exchange in China, the India International Bullion Exchange, and we've been working with commercial entities, mainly banks, to improve how gold is traded. And finally, we're also making investments in new technologies that can improve the integrity of the market. So one example is a new technology that can trace gold from the mine site to the refiner. And we're looking at a technology that can also track gold as it moves through the supply chain. That's a little bit about us. Dr. Mustafa mentioned the IOPI standard, which is when we first met. That is obviously an IOPI standard, but we provided inputs on how the gold market operates and functions. I'm going to give a brief introduction now to gold as an asset class. And of all the slides I present today, I think this is the most important one, because there's no other asset class that has this unique demand profile. You've got four key sectors of demand. You have jewelry demand, which is 33%, tech demand 7%, investment demand 40%, and the rest central bank demand, which is a subset of investment, really 20%. There's no other asset class that has that unique demand profile. What's important about this, though, is that each of those sectors of demand has very different drivers when it comes to their performance. And they react differently in the same macroeconomic situation. So when the economy is doing well, people buy more jewelry and more technology that uses gold, and that area of demand goes up. So you could argue that's a bit more pro-cyclical. When the economy is doing less well and there's uncertainty on the horizon, which certainly is at the moment, investment demand tends to pick up. And central bank is actually a little bit of both, which is why we treat them separately. It's important because that means that gold's performance as a financial asset is very different to other asset classes that are, say, pro-cyclical or counter-cyclical. And because gold performs differently as a financial asset, it can be an effective portfolio diversified. And that's one of the key tenets of the investment case for gold. So gold just performs differently to other asset classes. And as in a well-balanced portfolio, you perhaps need a risk mitigating asset, something that performs differently to improve your risk-adjusted returns. And I'll talk about that in a bit more detail. Gold is also a very global market. If I'd shown this slide 30 years ago, it looked very different. Most demand was in the Western markets, and that includes jewelry demand. If you look at the central banks that used to buy gold, they were primarily, not exclusively, but primarily Western central banks. That has changed over the last 30 years. So the central banks that are buying gold are now from the rest of the world. Western central banks aren't accumulating, they're not selling, but they're not accumulating. And if you look at jewelry demand and investment demand, especially jewelry demand, that has shifted to Asian markets. And China, India, and the Middle East are the top three consuming markets for gold. And it is still dominated by jewelry. It varies between markets, but here in the Middle East, jewelry demand is about 60% of demand, 40% is investment. So the market has changed. And so it's not just sectorally diversified, and that's the point about jewelry, tech, investment, central banks. It's also geographically diversified as well. Demand isn't concentrated or beholden to one particular jurisdiction. It's also traded internationally. The biggest trading centre, which is why we're still based in London, is London because of the liquidity of the financial markets there. But New York and Shanghai are big trading hubs as well. This is financial trading. So yes, there's some physical, but it's also paper products which wouldn't meet the requirements of Islamic finance. But this is how I'm just setting out how the international market currently operates. Production is also global as well, and I'll come into this a bit later on. But to understand how gold performs, you obviously need to look at the supply side. Supply is very geographically diversified. Again, if I'd shown this slide 30, 40 years ago, it looked very different. South Africa would have been the #1 producer and the biggest producer by far. Now gold production, because the mines in South Africa are deeper, therefore more expensive, and the resources are coming to an end. They're not at an end, but it's becoming a lot more expensive to mine there, and new technologies, new discoveries have led to production being geographically very diversified as well. And again, that's important because gold isn't therefore subject to the dominance of one particular geography. Other metals perhaps are, so palladium and platinum, for example, are dominated by 1-2 countries. There's a big debate at the moment about critical minerals and rare earths and so on, and all sorts of considerations about the security of supply. With gold, you don't have that because it's diversified. China, Russia, Australia, Canada, US, Ghana, and others, as you can see from here, are all large producers of gold. And therefore, the supply, you could argue, is more free. On the right-hand side of this slide, though, is a further breakdown of supply. In an average year, around about 5,000 tons of gold is consumed in jewelry, investment, and tech form. In the same year, around about 3,600 tons of gold is mined. And that comes from both large-scale mines, and small-scale mines, artisanal mines. But demand outstrips mined supply. Mined supply grows at about 1.5% every year. It takes a long time to invest in a mine, get it fully operational. It doesn't happen overnight. You can't just switch it on and off like you could perhaps with oil and other commodities. And demand currently outstrips supply. And the rest of supply is met through recycling. That's everything from individuals who've got scrap jewelry, for example, selling it to a jeweler, and they'll repurpose it into something else, or bars and coins, perhaps not coins because they're a vicious sector, but bars being used as feedstock, or industrial scrap. Gold is found in e-waste, for example. In a mobile phone, there is probably around about $100 worth of gold, and that can be extracted. And so, although 75% of supply is mined supply, 25% is recycling. It's important to understand that supply side dynamic because that also means that gold behaves differently to other asset classes. When the price really goes up and there's a bit of perhaps a squeeze, recycling picks up as well and can actually smooth it out. So it can smooth out some of the volatility that's derived from the supply side. I've got a slide on here just about the uniqueness of gold as a physical asset. We consider gold to be a dual asset. By that, we mean it's a commodity and it's a financial instrument, an investment asset. On the commodity side, though, its use case is within high-end electronics. So it's used in printed circuit boards, it's used in medical devices, it's used in space tech, it's used in some environmentally friendly technologies. It is because of these physical characteristics. And I won't go into it too much, but it's ductile, which means you can create a very thin wire out of it. Hence, it's used in printed circuit boards because it's also a good conductor of electricity. It has good thermal conductivity. It's reflective. It's malleable, so it can easily be worked. That's important for the jewelry sector. So for all of these reasons, gold has a technological application. But that, I would stress, is a small component of gold demand. It's only about 7%. But interestingly, it's an area that's growing. And it's growing partly because of two things. One, AI, and the need for high-end processing and chips. And gold is used in that. but also in some environmentally friendly technology. So it's used in carbon capture and storage systems, fuel cell technology, and so on. That's also driving a renewed tech interest in gold. But because of the price of gold, and there are metal substitutes, it's not always used. So it's only used when safety is paramount or when you have very high-end electronic item where durability is key. So if that isn't a major concern, there are other substitutes that can be used that are cheaper, but perhaps not as good because they can corrode. And gold is very stable. And so that's why you find it in space technologies, a very high-end electronics, especially where there's a safety element. So that's sort of a bit of a background to gold. I'm just going to quickly talk about physical gold forms. One of the uniquenesses of gold is it's fungible. It can be transformed from one bar into another, and different markets trade different types of bars. So the London market, which is the primary driver of the wholesale market, they trade what's called a good delivery bar, which is a 400 ounce, that's around about 12.5 kilograms bar, of a purity of 995. That means 99.5% gold within that bar. In Asia, and particularly East Asia, Singapore, I used to be based, Hong Kong, it's primarily a kilo bar, which is obviously 1 kilo, so just over a tenth of the size of a London Good Delivery bar, but it's of a high purity. It's usually 4 nines, which is 99.99% gold. Then if you go to other markets like Thailand, they will trade 965 gold there. India is 916. There's all sorts of different purities and different sizes of bars that are traded, and that's because of different consumer preferences, but it's also because of for investment, but it's also because of consumer preferences for jewelry. So India, for example, is primarily a 22 carat market. 22 carat gold looks very different from 24 carat. China is a 24 carat gold market. So there are some consumer preferences that have led to these differences. But what you have on the right is gold grains. These are very, very pure, and they're used either by the jewelry fabricators or tech manufacturers. On the left-hand side, you have doré bars. This is what comes out of a mine site. These are not investment products. The reason they're not investment products is that the gold content varies considerably. So you could have anything from 20% gold to 75, 80% gold. So this is what comes out of a mine site. That is then taken to a refiner who will then process it and turn it into something that's investment grade, i.e. bullion, and it's standardized. And then examples of bullion here, so you have a London Good Delivery bar, which is that trapezoid bar on the left, and then various bars of different sizes and shapes. Just one final point on bars. So I just want to provide a holistic overview of gold. There's two primary refining processes. There's a number of refining processes, but there's two key considerations: whether the bar is minted or whether it's cast. Cast is cheaper. Casting is just pouring molten gold into a cast and out pops the gold. Minting goes through a different process. You're creating a sheet of gold, a bit like a cookie dough. You cut it and you stamp it, and it has a very high surface, which for some consumers is important because they want the gold to look nice. That is more expensive to produce, which is why minted bars cost more than a cast bar. If you're thinking about just pure investment and you want exposure to gold, it doesn't really matter what it looks like as long as it's gold. So the London Good Delivery bars are cast, they're cheaper to produce. Kilo bars tend to be, not always, but tend to be minted. They look nicer, but they're more expensive. And the refiners prefer producing the minted bars because that's how they can generate a bigger margin. Whereas when they're casting bars, sometimes it can be a loss leader. I've already spoken about this, but there isn't a universal definition of a minted bar or a kilo bar, but there is of a London Good Delivery bar, which is what underpins the wholesale market. So gold ETFs, gold investment accounts tend to be, not always, but tend to be backed by these large long-term good delivery bars, which have certain requirements in terms of the shape, the diameter, the weight, the fineness, but also key, the due diligence that has been placed on the origin of gold by the refiner, which is called RGG, the Responsible Gold Guidance. So when you buy a bar like that, not perfect, but it's not just about the technical specifications of the bar, it's about the due diligence that the refiner, producer of that bar, has undertaken on the material that they're using to produce it. Bullion coins, before I go on to the investment case, which is really the main part of the presentation. Bullion coins, these have to be produced by an official organization, a mint, or a monetary authority. They are legal tender. You have something called a medallion, which is that could be a commemorative gold coin, or it could be something produced by a jeweler, for example, but it doesn't have a face value. And there are tax considerations that sometimes play out around that. But a bullion coin is produced by a mint, and it has a face value. It's used as currency. So, for example, a Britannia, which is the UK coin, has a face value of £100. But it's 1 ounce. So at current prices, it's worth 3,200 and something, whatever the current price of gold is. But it has a face value because it has a currency side to it as well. So official coins, bullion coins, do have a face value. This is important because there are tax considerations around that. In some markets, the EU and Singapore and so on, it has to have a face value for it to be tax-free because it's considered currency, whereas a medallion or a commemorative coin is not considered in the same way through the fiscal frameworks. Just finally, on technical standards jewellery, I've spoken a bit about caratage. Caratage is just the fine gold content, the number of gold ounces contained within that jewellery item. The rest is other metal that's alloyed. So 24 carat is the highest fineness you can get. In reality, nothing is ever going to be 100% gold. There'll be some impurities, but as you move down the caratage, so for example, 18 carat, which is what is traded in a lot of European markets, that's 75% gold. The 25% is another metal. That gives it a slightly different appearance. So for example, you want rose gold, you'd use copper. You want white gold, you could use palladium, rhodium, I believe. So it's about giving the piece of jewellery a different look, but keeping it at a certain value. Some people find 24 carat is far too expensive, but also 24 carat gold is softer, and it's actually harder to create a more intricate design. So the reason why an alloy is used is to make the gold more workable. This is really just from a jewellery perspective. I just wanted to include this so you just get an idea of the broader market, but I know we're really here to talk about this, which is the strategic case for gold. And the strategic case for gold was developed by the World Gold Council to underpin how we communicate to end investors, how we talk to central banks, how we talk to pension funds, large institutional investors, and individuals increasingly, about why we believe that gold makes sense in a portfolio. And there are a few misconceptions. One is that it only preserves capital, another that it's very, very volatile. And so we developed a model that can be distilled into 4 areas. And the first is looking at gold's long-term returns. The long-term return on gold is around about 8% per year. And the data that we use, unless it states otherwise, but most of the data we use goes back to 1971 when we came off the final gold standard, which is when the private investment market really opened up in the conventional financial world. But if you can look at different time horizons, and I haven't put data from this year because that will skew it, because it's been quite a unique few months. So this data is up to 31st of December last year. You can look at gold's performance over the long term and different horizons. It's been pretty good. Not the best asset class in the world, but it does generate a return and compares quite favourably to other major asset classes, some of which won't be Sharia compliant. The second consideration about gold or motivation for investing in gold is that it can protect purchasing value. I have another slide which I haven't included, but it looks at gold versus other currencies, and every other currency in the world is depreciated because it can be debased and quantitative easing and so on. But gold holds its own. It's a finite asset, it's a physical asset. It holds its own, but it holds its own especially in times of high inflation, and that's what we describe as anything above 3% inflation. Gold's historical return has been close to 13, 14%. And if you look at the data across multiple currencies, it's the same story. So one of the drivers of investment interest in gold is a need for a hedge against inflation. There are other hedges out there, but again, they're not necessarily Sharia compliant, and they're not necessarily as liquid as as gold, which is what I'll come to in a minute. So one of the first driver of interest in gold is that it can generate returns. Second is that the returns it gives can outstrip inflation. Another concern that people have is gold is quite volatile, but actually if you look at its volatility profile, it's pretty acceptable. So it's no more volatile than other major asset classes. Its volatility is in the range of acceptability. But I would also add that gold's volatility tends to be on the upside. And by that I mean when other asset classes are not performing so well, gold tends to come into its own. And that's when you see that upside volatility, which is something we're seeing now. I mean, this year so far we've had, I think at last count, 22 all-time highs for gold. Compare that to last year, we had 40 in the 12 months of last year. In the first 3 months of this year, we've had 22. That's led to quite a lot of volatility. Also, we've been asked questions, why has the gold price dipped a bit in the last couple of weeks? It's dipped, and I'll come into this in a minute, because it's being used as we believe it should be used, which is a source of emergency liquidity to safe haven. So you don't really want to use it. When you have to, and people have had to in the last couple of weeks to meet margin calls, for example, what was the easiest thing to sell? It was gold. And it was easy to sell because it's more liquid than many other asset classes. In an average day, $227 billion of gold is traded worldwide. And that trading takes place all over the world. It takes place in the souk, in Dubai, it takes place in Bangkok, Chinatown, it takes place in Hong Kong, it takes place in London, New York, it takes place everywhere. If you add all of that up, $227 billion of gold is traded every single day. But it's also universal, very easy to sell. It has a universal understanding. If you buy gold here and take it to Singapore, you'll have a buyer, and vice versa. It's a universal currency, if you like, despite the different forms it takes. And so that makes it very liquid, not just from a financial perspective, but also from a logistical, physical perspective as well. It's easy to sell if you want to. Now, the gold has to be melted down, and there's considerations and costs associated with that, but it is a source of liquidity when you need it. And then moving back to this slide, the final sort of piece of the strategic case for gold jigsaw is its role as a diversifier. And it goes back to that slide at the beginning that I showed, which looked at jewelry, investment, tech, and central bank demand. All of those sectors of demand have different drivers. They react differently in the same economic situation. That's reflected in gold performing just differently to other financial assets. And it performs differently to other financial assets because it isn't strongly correlated to other financial assets, particularly in downturns. So what this slide looks at, we use the S&P 500 as a base, but when the S&P 500 is up by 2 standard deviations or more, you can see actually gold becomes slightly more positively correlated, and that's what you want. When the economy is doing well, you want gold to be doing as well. But when the economy is doing less well, so at the bottom of this chart, when the S&P 500 is down by 2 standard deviations, that correlation changes. and it becomes slightly negatively correlated. And that's because of, again, it goes back to that demand profile for gold. When gold is performing well as it is now, jewelry and tech demand come off. It just becomes too expensive for consumers. But then with investment, you get tactical positioning, you get momentum that drives interest in gold. And so it picks up, so it's got a natural floor, if you like. So even though I would say it's not highly correlated, which is what you want from a diversifier, it does become slightly more correlated when the economy is expanding and doing well. So that's the strategic case. I'm about halfway through. I'm happy to take questions on this, or we can carry on. But if there's anything you'd like to ask about the investment case for gold, happy to take it now. Dr. Mustafa mentioned Matthew. Matthew has been a practitioner in the gold market for a long time, former bullion banker. So I'm looking at this from a theoretical lens. Matthew has been doing this and trading gold and facilitating bullion banking for many years. So Matthew would also be happy to take any questions. If there isn't any, I'm happy just to carry on.
So what do you say? Would you like it to carry on and then we have a discussion at the end, or would that be a good idea? Would like to sit in between. Huh? Huh?
And okay. So I'm going to talk about gold demand trends. So I wanted to talk about this because it kind of gives you an idea of what drives gold's performance. So the data I'm going to show you is the annual data from last year. I mentioned there were 40 all-time highs last year. It was really a year of two halves. In the first half of the year, it was retail demand from China, from India, that was supporting gold. Then China entered into some domestic economic difficulties and pulled off. But in the second half of the year, we saw monetary authorities around the world, starting with the ECB and the Fed, starting to cut rates. And that was a major catalyst for investment demand and institutional interest in gold. So as retail demand pulled away, investment demand picked up. And that started around about July, August. What was consistent, though, across the year was central bank demand, which is 20%. Central banks have an outsized influence, though, on gold's performance just because of what they are and the attention they get. So when a central bank buys, everybody notices, and that has a knock-on, I guess you could say, network effect. But they've been consistent buyers for many years, and I'll talk about them in a bit more detail. Gold performed well across in fact, all major currencies. It was up 28% in US dollars, which is important here given the peg. And that investment demand was indicated by what happened in the exchange-traded fund space. The gold ETFs are a new vehicle. I'll say they've been around 20 years, but they're a vehicle for some institutional investors to access the physical gold market. And there are two types of ETFs, broadly speaking. There are those that are physically backed, i.e. when you're investing in the share, there is a gold bar that is allocated underpinning that, and there are paper ETFs. So all the data I'm talking about here is those physically backed ETFs. They only represent about 2% of demand for gold. But what they are, though, is an important canary in the coal mine indicator of investor sentiment towards gold. And we've had net outflows from ETFs for a number of years now. That started to change in August last year. The Fed started to cut interest rates. And that's really what led gold to perform as strongly as it did towards the end of last year. There were a couple of other, I guess you could say, hiccups along the way. We saw I think most analysts were expecting the US elections to be uncertain in terms of their outcome. And that led to a lot of buying as we entered into the US election period. When it became clear that the outcome was clearer than perhaps anticipated, some of those trades were unwound, and that's why we saw gold dip a little bit, correct, in November. But on the whole, the big driver of gold's performance has been interest rates and pressures on the US dollar. Jewelry, I've mentioned, jewelry demand is down by about 11%. That's primarily because of the high gold price. When the price is high, it's retail demand that is more sensitive to that. This is nothing unusual. When the price goes up, jewelry demand tends to go down because people are buying lighter pieces. But actually, if you look at the value of jewelry bought, that has actually gone up, which is another indicator of perhaps the uncertainty that consumers are trying to protect themselves against. That's particularly true in markets like India and China, where jewelry is both an investment and an adornment. In other markets, Western markets, jewelry is primarily adornment. You buy it for adornment purposes, not for investment. In markets here, in India and China, jewelry is considered, or the financial investment motivations and wealth preservation properties of gold are a part of the buying consideration, where they're not perhaps in Western markets. India, which is the second largest jewelry market, did see a dip, but not by much. And that's primarily domestic. Two reasons. One, India is doing very well economically, or relatively well. Booming middle class, very optimistic market at the moment, perhaps along with the UAE in this region. India is one of the most optimistic markets at the moment economically, but also there's some reforms that took place in India. They've typically had quite high tax rates, import duty on gold, GST on gold. That was simplified and reduced in August last year, and that led to a bump in jewelry demand in India. But across the board, really, jewelry demand was down. Foreign coin demand, retail investment demand, that was fairly flat. And it was flat because of the high price, but it was also flat because of although we'd entered into a rate cutting cycle, there was still a big debate about how far and how quickly those rates are going to be cut. And then we started talking about tariffs, and they'll be inflationary. And if they're inflationary, what will that mean for interest rates? Will interest rates still be cut? I've spoken about ETFs. What I would say about ETFs is they're a bellwether of institutional interest in gold, but most ETFs are still domiciled in the US, UK, Germany, and Switzerland, the top four markets. So they tend to be more of a bellwether of economic sentiment and concerns in those markets. But interestingly for ETFs, China and India are growing considerably. The AUM is still very, very small comparatively, but it's where we're seeing significant growth in those products. And there is a debate, something we're looking at through our research, of people switching. So in India, which has been a big jewelry market for many, many decades, as younger people have access to a wider range of financial products, and demographics change. Are they going to buy jewelry in the same quantities that their parents did? And if not, are they going to invest in gold in a different way, perhaps through ETFs or online gold investment accounts and so on? Finally, central banks. They've been net buyers since 2010. So at the end of the 90s, National Bank of Switzerland, or the Swiss National Bank, the Bank of England sold significant quantities of gold. And it wasn't managed particularly well, particularly in the case of the UK. And it led to a lot of market disruption and put significant pressures on the gold price, which caused issues for other central banks that were holding gold. And so the central bank, through the World Gold Council, came together and signed something called the Central Banks Gold Agreement, which was a way of managing their activity in the market so that it was communicated more effectively. And essentially, the legacy holders of gold, so the Bank of Japan and what's now the ECB and other central banks, stopped selling gold. But then from 2010, emerging markets started to buy. And that's been a consistent picture for the decades since, the 15 years since. And in the last 3 years, central banks have bought almost 1,000 tons of gold per year. And in 2022, it was a record year for central bank buying. And they're driven by slightly different factors, which I will talk about shortly. But when you want to think about how gold performed last year, three things. Central banks, consistently strong buyers. Retail demand tapering off because of the high price. But taking up some of that slack was investment demand, driven primarily by macroeconomics and the interest rate cutting environment that we started to find ourselves in. And when you look at the impact of interest rate cuts, it tends to be front-loaded. So we produce a lot of research on this, and all of our research, by the way, is free on our website, goldhub.com, so you can find it all there. But we've published a lot of reports about the impact of entering into a rate-cutting environment, and you tend to find the impact is front-loaded. As the cycle plays out, the positive impact on gold tends to diminish in marginal terms. So finally, I'm going to talk about gold as a reserve asset, because it is the key component of the gold demand. So central banks, as I said, they account for about 20% of demand for gold. But their influence and impact on gold's performance is large, because they are important institutions. People pay a lot of attention to them. You get that network effect that you perhaps don't have with other sources of demand. And central banks, they are concerned about three things: safety, liquidity, and return. And I haven't really spoken about safety. I've spoken about liquidity, I've spoken about returns, but I've not spoken about safety, which is what I want to do over the next sort of 5 minutes as we wrap up and move into questions. Gold is considered safe because of its physical nature, physical real assets, but it's considered safe because as long as you own it in an allocated way, and I'll talk about that in a minute, there's no counterparty risk. It's not someone else's liability. If you own it outright, it's yours. You have legal title to it. And so that's primarily why gold is considered safe from a legal, physical sense. It's considered safe from a financial sense because of its performance, and I think I've spoken about that at length. But in terms of its performance in periods of high systemic risk, and when the VIX index was up, if you look at most major global periods of stress, global financial crisis, COVID, what's happening now with potential trade wars and so on, European sovereign debt crisis, gold outperformed other asset classes. And it outperformed those asset classes because it's liquid, and it performs well and is highly correlated, particularly in downturns, to other asset classes. What I would say, though, in the major crises of the last 20 years, so the financial crises of 2008, 2009, COVID, more recently, although it's not a financial crisis, but it's certainly a period of acute uncertainty and challenge, gold dipped a little bit. And it dipped because people were selling it. They were selling it to meet margin calls. Everything else, the liquidity had dried up. But gold, it's universally understood, it holds its wealth, it's liquid. And so it's performing in a way that we don't really want to have to test. Nobody really wants to have to use gold in this way, because it means that something quite serious is going on. But it is considered a safe haven because of how it performs during stress events, but it's also considered a safe haven because when you own it outright, it's yours. There's no counterparty risk. The legal title is yours. Central banks add gold to the reserves in a number of ways. They buy through bullion banks who will source from the London bullion market, or they might buy domestically. So central banks of the Philippines, Ecuador, Mongolia, and Colombia and a few others, they buy from domestic production. And we've actually been working with these central banks to use their buying power as a tool to improve the artisanal and small-scale gold mining industries in the countries that they're buying from. There are lots of challenges with ASM. The first is ensuring that the miners, who are often driven by quite serious socioeconomic challenges and need a livelihood, they need instant and quick payments. But often, unfortunately, gold in artisanal mining is subject to the use of mercury, which is environmental and health challenges. We have issues around child labour sometimes, and also the influence of malign actors. So by central banks buying directly, they can use their buying power as a lever for change and to improve the formalisation of artisanal gold mining. So a lot of central banks are looking at this, and the four that are really looking at it at the moment, as I said, Philippines, Ecuador, Colombia, and Mongolia. But the biggest vehicle for accumulating reserves is to buy from the open market, from people like Matthew in his previous career, where they would source bars on the open market. They do, a lot of central banks have inherited a lot of stock of gold, and they're sitting on that, but those are accumulating. Most of it is bought through the open market. They occasionally buy through ETFs, but that's slightly different reasons and reporting requirements, and so on. What do they buy? They buy good delivery bars. Non-good delivery. I've spoken about the technical elements of those bars, but the key consideration to think about is this is how the international gold price is derived. The price that you see on a Bloomberg screen for gold, so it's priced in US dollars per fine ounce of gold. There's a little bit more to it than that. It's the price of 1 ounce of fine gold in a London good delivery bar in a vault within the M25, which is a road network within London. It's very, very specific benchmark, and that's what it is, it's a benchmark. Most markets will trade at a slight premium to that. Some at a discount. To buy is sometimes a bit of a discount, but it is the most liquid market, and that's why central banks source from it, but also because of those due diligence requirements that the refiners place on their sourcing, gives the banks a degree of comfort that the bar has been sourced from material that has been processed and produced responsibly. Central banks, though, they don't just buy gold and keep it and protect their national wealth. They also provide services to the market. And the Bank of England, the Bank of France, BIS, the Swiss National Bank and the Fed all provide services to the market. And so some of that will be vaulting other central banks' gold. Others will be investment services. Some will be more logistical support and market making and so on. But the biggest service they provide is custody. And the reason why a central bank might want to custody gold at another central bank is for liquidity purposes. Because once you've taken and repatriated the gold, it's a physical, logistical challenge if you need to sell that at some point. So by vaulting it in a more liquid market, you have access, you can use it as an emergency source of liquidity. Interestingly, of all the central banks except BIS, they only offer allocated account services. And I do have a slide on allocated and unallocated accounts. And this is quite a key concept in the gold market, because there are two ways of, in the conventional world, owning gold, allocated or unallocated. Really, the only time you're owning gold is allocated, because that means that you have title over a specific bar. So each bar has a serial number, and when it's allocated, you are the beneficial and legal owner of that bar. It might be vaulted somewhere else. It might be vaulted at the Bank of England or at Brinks in the DMCC just down the road, but if it's allocated, it's yours. It doesn't belong to the Bank of England, doesn't belong to Brinks. they're just storing it for you. But because it's allocated, it's yours, you have legal title, and you therefore have no counterparty risk. Unallocated is different. What you're owning is a claim on gold. So that gold sits on the balance sheet of someone else. And this is used for all sorts of reasons. But the important part of the market, and the market that we at the Royal Gold Council like, is the allocated market, because that's the link with real physical gold. But I just wanted to flag it because there are lots of different terms out there. Another term that's often used is segregated. Segregation is not allocation. Segregation is just how gold is stored in a vault. If it's segregated, it means that all the gold belonging to one particular owner is in one particular place. The Bank of England, they don't segregate the gold. The gold is allocated, but they've got, I think, 500,000 bars there, and they're all over the place. So you might own bar 1724. They won't be segregated in the same place. They'll be found all over the vault. But segregation is not allocation. It's an important distinction, because in the retail market, for example, it can lead to confusions about what the risk profile of the product is. And it's really important for end investors to understand whether gold is allocated or not. And it's only when you buy allocated gold that you can really consider it a safe haven, because it's yours and yours alone. I've spoken a little bit about the price. The price that we see internationally is for a very specific scenario: 1 ounce of fine gold within a London Good Delivery bar in a vault in London. But that's not the price you would get. You wouldn't get that price, or most people wouldn't get. You wouldn't get that price because markets, in other markets, because you have to factor in logistics costs, storage costs, production costs. If you're buying a kilo bar, for example, as I mentioned, they're often minted. That costs money, and therefore there's a premium associated with that product. It's only really large institutions that can realise the benchmark price. So finally, I'm nearly done. About 20 past 11, so we've got 20 minutes for questions. I'm just going to talk about a central bank survey. I was talking to somebody earlier this morning about de-dollarization and the impact of that and the role of gold in that. Now, we run an annual survey of central banks. We publish it in July. So the data I'm going to show you is from the last survey that we undertook, which was in 2024. And we talked to central bank reserve managers on an anonymous basis. So we don't see who's responded, and that's important because central banks are quite sensitive about the messages they potentially put out to the market for understandable reasons. So first of all, this is what we find. You can find in the IMF data on our website, but just the current composition of central bank reserves. So gold accounts for about 16% of reserves across the board. The key point to note here, though, is there are many central banks that don't hold any gold, and there are quite a few central banks that hold a lot of gold. So this is an average, but it's remained fairly consistent over time. It is growing slightly, but the biggest change in composition has really been the weighting attached to the US dollar, which is still by far the biggest reserve asset. But you've had other currencies being part of the mix, euro, renminbi, and others. We also asked central banks, what proportion of total reserves do you think will be denominated in US dollars 5 years from now? And you can see that most central banks think that the proportion of US denominated assets will decline, but only moderately. And that's probably because the US dollar is difficult to replace. It's still a major trade settlement currency. International commerce is dominated in US dollars. And I would flag this survey was undertaken before recent events, but the US dollar is still considered a safe haven. But the longer term outlook is certainly one for slight de-dollarization. What does that mean for gold? So we asked what proportion of total reserves do you think will be denominated in gold 5 years from now? And conversely, most think that there'll be a moderately higher role for gold in central banks 5 years from now. We also asked central banks, why do they buy gold, and what factors lead to consideration of gold? And the long-term store of value, its performance during times of crisis, its role as a portfolio diversifier, the fact that it has no default risk were the top reasons for buying. So they share the same rationale as many other investors. What we do find, though, is central banks think about things a little bit differently. They're more concerned about liquidity than they are performance, whereas a commercial investor tends to be more concerned about performance than liquidity, even though both are important factors. So it's more about the weighting that they give to these factors rather than a difference of motivation overall. We also asked central banks, do you think global central bank gold reserves are likely to change over the next 12 months? So bear in mind, this was asked in July last year. 81% thought that it would, and that it would grow in importance. And so we'll be able to test that when we redo this survey in July, but the data shows that this really has come to the fore. And the final two questions, which I'll just run you through, is where do you currently vault your gold reserves? And most still vault in the Bank of England, with a proportion that's held domestically. There are historical reasons for that have led to that, but what underpins it now is just the liquidity of that market. But that is likely to potentially change going forward. We are seeing central banks repatriate some of their gold home. The Reserve Bank of India brought back 100 tons last year. We've seen it in Germany, Poland, and other countries as well, where they're bringing gold back home, because even though they might own it outright, and legally there shouldn't be a counterparty risk, there is a view that, well, if it's not under our jurisdiction, could that in itself be a future counterparty risk? Some are looking at other alternative locations, but actually most are thinking about repatriating domestically. So that's over an hour, just a potted overview of the gold market. I think the key slide, I'll put it back up as we finish. The key slide to understanding gold is that first one, this one, because there's no other asset like it. So we're often asked, for example, Bitcoin, is that the new gold? But it's not a safe haven, it's not a physical asset. It might be performing particularly well, but it's more highly correlated to the equity markets, for example. It's a speculative asset. It doesn't have jewelry demand, doesn't have central bank demand, doesn't have tech demand. There's no other asset like this. Some people ask, well, what about silver? Well, silver, this looks very different. Silver is not a central bank reserve, and it's primarily industrial asset. So the tech side of silver demand is much higher in terms of weighting, which means it becomes a little bit more pro-cyclical, if you like, or an expansionary asset. So I just want to leave on this slide because this, I think, is key to understanding gold's role as a financial asset and its performance in financial terms. So thank you very much. Thanks again to Dr. Mustafa and Prof. Munza and colleagues, Dr. Yasser, for organising this. Happy to take questions. Matthew's here as well. My details are flash on the screen. Please do feel free to email me. We have a lot of data research, so if you're looking at gold, happy to point you in the right direction. There are various tools as well, including a valuation framework, a return attribution model, which is something that codifies what has driven gold's past performance. The valuation framework is something you can use to deduce gold's potential future performance, and other tools as well.
Thank you very much.
Please join me once again to thank Andrew for this wonderful presentation.
And I think it was really good, well structured, and I like the pace in which he gives the speech. I almost, got lost of the time. I was keeping, a track of the time, but I just got lost in his presentation. He covered a lot of area about the physical features of gold, the diversification of gold, investment of gold, etc. Now we are going to open the floor, and I see curious students, if the faculty members would allow, I will give chances to the future generation first. This is a democratic process. And please introduce yourself and then ask a question directly to our speaker. Thank you. And be straight and direct to the question, because we have around 15 to 20 minutes. Thank you. Yes.
I don't know whether we should give, can you hear? I think I need to give a mic. Just a minute. This one. Would you like to take it from here or from there? No, from there. Okay, wait. That's better.
Hello, I'm a student here at Stanford University, College of Education. Thank you so much for your introduction, and I truly appreciate how you explained it. If I can ask another question, in today's world, a lot of young people are more attracted to.
Can you bring the mic close here?
A lot of young people are more attracted towards investing in cryptocurrency and other digital assets instead of being a safe, liquid, and high risk. So, from your experience at the World Council, what would be your sincere advice as next generation? And where do you think we should focus more, gold or crypto as well?
Thank you for the question. Perhaps I'll just repeat it if the Zoom, I'm not sure if they can pick up, because the mic is a different one here. So there's a question about younger people and being, I guess, pulled in a different direction, away from gold into crypto and other assets, and how does gold sit within that? It's a very interesting question. It's something we are, we're looking at. It's happened, I was talking about India, which is the second largest consuming market in the world. Younger people there are buying less jewelry, for example, which is traditionally the vehicle for accessing the gold market. We get asked this question in other markets: is crypto the new gold? I'll go back to that slide that looks at the demand profile. Crypto, it's not a tech asset, it's not a jewelry asset, it's not a central bank asset. But has it given good returns? Yes, it has, but it's got a lot of volatility. So what I would say is actually there's still a role for gold, because if you're investing in crypto, you have counterparty risk, you have market risk, you also have regulatory risk. The regulatory risk for crypto, a regulatory regime for crypto isn't fully settled. Some markets are banning it, some are very open to it. You've got that regulatory risk. So by all means, it can play a role in a portfolio, but you might want to diversify some of that risk, and I would argue you can diversify with gold. So in some ways they're complementary, but there is a competition for mind share, certainly. And something we're looking at is how gold is traded and retailed. Younger people do have a preference for trading online, buying assets online, interacting online. And so we're looking at things like tokenization of gold, which already exists, but there are challenges associated with it. But diversifying the channels of access to the gold and making sure that gold trades on the same kind of platform. So if you're buying Bitcoin, you can see, actually, maybe I want to diversify or mitigate some of that risk through gold as well.
Thank you so much for the answer. So, if young people like us would like to get involved more in the gold investment sector, are there any platforms such as getting involved in research or internship, especially with the gold?
That's a good good question. Something, and I'll answer. So there's a question for those online just about how can somebody, I guess, start a career in the gold market? And there are lots of institutions involved in gold. Something that we're doing is we're developing a training program, professional development program of gold, which is targeted at people who are interested in a career in gold or have just started a career in gold and want to learn about another element of it. But there are a number of different organizations in the supply chain, banks, bullion banks, big gold desks, and they undertake research, market analysis, or even, they'll have sales teams who are selling gold. You have big brokerage firms. You have independent research companies. So there's a company called Metals Focus that produce a lot of data on the gold markets. There are lots of different opportunities. And here actually in the UAE, you've probably got more than anywhere else in the world. Because if you think about some markets, Singapore, UK, tends to be more just financial institutions. Here you've got the financial institutions, you've got jewelry, you've got the refiners, you've got a whole wide range of participants in the supply chain. So lots of opportunities, yeah.
Yeah, wow, okay. I think the sisters are very active, huh? The next question.
Hello, I'm Mara. I'm the Faculty of Economics, my first year. Actually, I have two questions. The first one is this the right time to invest in gold, and how can I know if it's the right time to buy gold or not? The second one is, what is the expectations about the gold market now? The third one is it better to invest in gold or stocks?
Thank you. I'm not allowed to give investment advice. I'm not qualified to give investment advice, but we view gold as a long-term strategic asset, not something that you just sort of speculate on short-term prices. We believe it plays a fundamental long-term role in a portfolio. So even if people are concerned about the current high gold prices, the way you can smooth that out potentially is to just accumulate slowly. There's things called gold accumulation plans, which we launched in China with ICBC Bank, which allow a consumer to buy gold on a regular basis. So they might, for example, say, right, I want to invest 500 dirhams of gold or 500 renminbi of gold to China every month, and the bank every business day purchases gold on their behalf, and that allows you to smooth out the price. So I would, we'd argue that gold is a long-term asset. When it comes to other asset classes, I mean, there are benefits of all, and we're certainly not gold bucks, so we don't say you should only put money in gold. That's not appropriate. What we say is you should have a well-balanced portfolio with where you maximise your risk-adjusted returns, and there's a role for gold in that. Equities do play, an important role as well as part of a well-balanced portfolio. But I say that without giving any sort of specific advice.
I think there's also interest. There are others following online, so they want to ask questions. It seems we'll have to restrict the question later. Sure. Maybe we'll take be online.
Assalamu alaikum.
Alaikum assalam wa rahmatullahi wa barakatuh.
I have a question as regards to this topic and to the student life. As a student, as a normal student that studies as a bachelor, can I start now on gold trading or no, or it's not permissible?
As a student, can he start now? He's still a fresh student. Can he start on gold trading now, or he has to wait?
So yeah, just for the audience, there's a question about, as a student, can I start being active in the gold market now? I mean, yeah, you can, but you just need to be aware of the risks, do the research. One of the benefits of of some new products is that the entry point for accessing the gold market has been brought down. The 400-ounce bar of gold, which is what underpins the institutional market, at current market value, they are very expensive. Think about $1 million plus. That will current prices. So out of the reach of of many, but new products allow access to different entry points. But it's important, with any, and this is not gold specific, but any asset class, any financial vehicle, I think understanding is key. So doing research, interrogating the product, interrogating the counterparty, bringing yourself up to speed. And that, I'd say how we talk about gold is as a strategic asset, a long-term asset. So not really something for the short term, but something that can help financially protect you, hopefully many decades to come.
Thank you, Joe, for the presentation. I would like to hear your opinion for individual items. How does investing in gold compare to investing in real estate and so on, return long-term value?
Thank you for the question. For those online, the question: how does gold compare to real estate? That's a good question. I would say gold primarily is different because it's universal. It's standardized. There's an international price. Yes, there are different forms of gold, jewelry, different types of bars, different types of coins, but it's completely fungible. Whereas property, different. There's a role for property, of course, but the location of the property and other considerations impact the performance of that particular asset class. Whereas gold is more universal, more international, less subject to the economic situation in a particular market. That can, yes, impact the performance. Probably the US has the most outsized influence. But with property, if you're buying here or in London or wherever, its performance is very much dependent on local market conditions. So it's just very different kind of proposition, whereas gold is universal in terms of the product itself, because it's fully fungible, but also in terms of what impacts its performance.
Okay, we have to, can we give to the staff now? We have to.
My question is on the survey from the central bank. As a statistician, I would like to know more on the trades, like all the central banks all around the world responding to the survey or not. Also, were there any decomposition of data based on the economic status, like whether it's paying in developed countries or educated different factors? And also, was there any change in, for example, financial crisis in terms of how central banks tend to manage the users or not? And based on that, what do you expect for the future if we face any similar crisis, like economic crisis or financial crisis regarding changing investments? Thank you so much.
Thank you for the question. So the question about our central bank survey and I guess the data behind it. I will share after I can share the report, and it has a lot of that information. Because of the sensitive nature of central banks, we don't report which central banks responded to the survey. But I have the data, I believe it was 80% of central banks have responded. We do break it down for emerging and advanced markets. And you can look at the data set historically as well. So it's a bit of a longitudinal survey. Sentiment has remained pretty similar in the years that we've run the survey. The second question was about the impact of crises events. whether that's changing views of gold. I would just point to two things. One, height of COVID, we had record central bank buying, and COVID was definitely a huge catalyst. So that was in 2022, and that's continued since. Also, central banks became net buyers for the first time in 2010, just after the 2008-2009 financial crisis. So the safe haven properties for gold and its performance during times of systemic crises has certainly been a big driver of central bank interest. Matthew, do you have anything to add? Because I know you've been dealing with central banks in the past.
Yeah, I mean, central banks have been buying gold and bulk gold for generations, 100 years or more. I think their rationale, I by the way, used to work in central bank management for commercial banks for a number of years, a couple of decades actually. And I think earlier in the century, we were certainly seeing central banks building gold, always the diversification, always the mantra that gold is nobody else's liability. But certainly at the beginning, at the turn of the century, we were, as I say, yield was quite a big factor in why central banks were holding gold. And that really, to Andrew's point, the various cycles that we've had in the last decade, yield is not relevant anymore. Being able to holding gold as a non-yielding asset was always a little bit of a problem. Certainly in the late 90s and the early 2000s, central banks were selling their gold because it wasn't providing yield. Yield could not be further away from an important issue now. It's not. It's all about diversification. It's about having and the survey didn't show it. But in my opinion, as if we do the survey again this year, we'll see that moving away slightly from the dollar as safe haven, having a little bit of a move to go into something that's neutral like gold is something that I believe is starting to happen. I could say that as a consultant to the World Gold Council, not absolutely representing the World Gold Council, but that's my opinion. I think the dollar has really been knocked in these last few weeks and months. And for me, having worked with the 40 largest gold central banks in my career, I do believe that there will be a continuation with diversification out of currencies into gold.
Thank you. Dr. Kash, okay.
Thank you so much for the presentation. I just have a quick question about gold volatility, gold price volatility. I was kind of wondering what type of modeling that you may develop the World Gold Council, and what are the most important factors that maybe from your experience and analysis that you may have done before that leads to the volatility of gold price?
Sure. So the question about volatility and the tools that we have, and we have some broader tools that can be used. I mean, there are lots of different factors that impact gold's volatility. I mean, its liquidity, leads it to be sold in times of stress. So gold went down last week, 10 days ago, because people were making margin calls. There's lots of little things like that. But also, because there's a demand structure for gold, the retail demand in particular, and the institutional investment demand, and also the outsized influence of central banks, all sorts of factors at play. So we have a couple of models that might be of interest, and we worked with a company called Oxford Economics. They provide the intellectual model. I'm not a quant person, but they produce their model for interrogation by quants and analysts like yourself and people in this room who really understand it more than I would. But there are two models I would point to. In fact, three models I would point to. Gold valuation framework, which is forward-looking. GRAM, the gold return attribution model, which is probably more relevant to the volatility question about what has impacted gold's performance. And we publish the results of this on a monthly basis. So each month you can go and say, look, actually central banks accounted for 8% of gold's performance, jewelry demand here is this, and so on. So it's a bit more backward looking. The final model is called GLITTER, which is the gold long-term return attribution model. And that's to look at gold's historical performance and the drivers of that. And the number one driver has been GDP growth. So you look at what's happened since 2002. India is booming. China has also grown considerably. China opened up its gold market in 2002, 2003. And the biggest single factor that has influenced gold's long-term performance, not short-term, but long-term performance, has been rising incomes, supported obviously by GDP growth in India and China.
So the last question is,
of course, thank you and all the information you shared with us about the global market. The question for our students, how do the central bank policies and interest rates as well affect the world crisis in short and long term? We all hear that federal government only
Yeah, I mentioned, okay, so in the long-term driver of gold's performance, it's rising GDP. In the shorter term, it's interest rate. It goes back to the point about gold not being a yield-bearing asset. So when interest rates are high, the opportunity cost of holding gold also goes up, because there's no coupon when it comes to gold. So when interest rates are high, that is a barrier to institutional investment to gold. So it's why in a higher interest rate environment, gold tends to perform less well than in a lower interest rate environment. It's why gold really started to take off last year when the ECB and the Fed started cutting rates. So the major headwind for gold is interest rates, and obviously because of the role of the US in the global economy, US interest rates are key. And that plays into other relationships. So for example, gold and the US dollar and the REIT dollar being potentially supportive of gold. But the key point is the opportunity cost of gold comes down when interest rates also come down. And also you have, so what happened last year as well, we saw an interesting phenomenon in markets where you saw the equity and bond markets becoming more correlated, which was quite unusual. And that actually led to greater focus on gold, because the need for a diversifier was even more acute. Because gold is about diversification. And when your other asset classes are more highly correlated, the need for an uncorrelated asset goes up.
Thank you very much, Ivo. There are a lot of questions. I see the sisters and the brothers raising hands, but I'm sure Matthew and Mr. Andrew will still be here for a few minutes. You could have some kind of casual interaction with him to answer those questions. Once again, I would like from the beginning to thank the Sharjah Center for Islamic Economics for hosting this interesting workshop in collaboration also with our College of Economics and Management and then the College of Sharia. We really appreciate all those cooperation and appreciate also the attendance. It has been very, very good. Because I saw a message by our dean of the college, and it seems everybody has responded to his message. Thank you very much, Prof. Munzir. That was really great. And don't forget our guests who came from far away to attend the session. Jazakumullah khair for attending. And we hope to have such sessions more and more. And don't forget, tomorrow we have the big event, the conference. And don't wait for Dr. Munzir to send another message. I believe that is sufficient. And in conclusion, really would like to thank our speaker, Mr. Andrew. It was wonderful, and I think Matthew also had a very good introduction in the talk. And once again, we conclude by saying, Wassalamu alaikum wa rahmatullahi wa barakatuh.
Thank you very much. Great. I think we'll have to have it. So many questions. Thank you very much. Thank you very much. Thank you very much.